Look, the accelerated tapering, I think, is all priced in because there's been a combination of the recent announcements from the Fed, which have been obviously a tad more hawkish. There's been a dropping of the term transitory, effective dropping of that language anyway. The narrative has changed somewhat. We still see continued robust inflation, actual realized numbers, the data. All of that sort of suggests that the expectation on tapering is pretty much by now sort of priced in. The issue, as your previous reports have alluded to, is exactly to what extent they feel the confidence to really move on interest rates next year. We're still sticking to the view that 2 looks the most likely outcome. I think there are still question marks from the Fed regarding realistically just how robust this recovery is. The inflation story, I think, actually is a done deal in terms of elevated inflation, which is here to stay, at least for the short to medium term. But the extent of the recovery, potential for restrictions and lockdowns, once again, it may be a small probability in terms of the US economy. But all of that, of course, will figure into what the longer term growth expectations are and what the impact is on the labor market. So the Fed may give itself just a little bit of wiggle room to indicate forward guidance on 2 hikes next year rather than a third. So I think markets would actually be, obviously would be happy with that because it shows a Fed that is finally acting, but is not necessarily putting its foot on the brake such to stop the risk trade. And of course, there are further implications in terms of where the ultimate neutral rate is. There are implications in terms of where real rates will end up. So I think any signal of a two hikes next year, markets would take that in its stride. Three hikes, and it's a slightly different story.
Okay. Can it afford to just stop with 2 hikes? You mentioned might want to leave itself with some wiggle room. But does it have any wiggle room when consumer prices and the acceleration that we're seeing there is at a 40-year high, and the PPI number that we got out overnight at annualized 9.6% was a record?
Yeah. Look, there's no hiding from these numbers. And some of the work that we've done at State Street has looked as well at, other ways of looking at inflation. So it doesn't really matter which angle you come from. If you're looking at it from a core perspective or a headline number obviously incorporates those prices that the Fed will tend to overlook, things like energy prices. It's the core prices that I would look at very, very closely. The fact that you've got 5% core inflation speaks of an economy that is now factoring in quite significant price expectations, whether it's a wage growth spiral or whether it's underlying price conditions. It doesn't have a lot of wiggle room. But at the same time, the Fed will be very, very conscious that what it doesn't want to do is it doesn't want to be seen as the headwind to growth recovery. And there's an important point here, and Brian Moynihan mentioned this actually on the last report, which is expectations of growth this year and next are actually very strong. But move forward to 2023, and suddenly you see a slowing down in US growth expectations, which is a long way away. But actually, what the last thing the Fed wants to do is actually put anything in train that would necessarily accelerate a growth slowdown quickly in this particular cycle. So it's always easier for the Fed to be somewhat behind the curve and catch up than over tighten and then have to reverse. And that's the way that the Fed will look at things.